Yes, great to see your first quarter numbers. You must be pretty happy with those. You said business momentum remains strong as well. How confident are you, though, that you can deliver more of the same to shareholders, particularly given a lot of the political and global economic headwinds we're facing?
Actually, I would say the political and global economic headwinds have actually lessened in the course of this quarter. The back end of last year, there was a lot of uncertainty about the trade situation and a whole bunch of other moving parts. Since then, China has obviously put the fiscal and monetary stimulus in place, and the trade negotiations seem to be heading well. So if anything, the first quarter saw tailwinds as opposed to headwinds. On top of that, the fact that most of the central banks have actually leveled off monetary policy tightening, perhaps even in some cases easing monetary policy, that's always helpful to global economic conditions. And therefore, for my money, I think the overall environment is clearly better than it was a few months ago. Interestingly, our business momentum, our pipelines are looking quite robust. I mean, as far as we have transparency, they're looking quite good. So yeah, I'm quietly optimistic, shall we say.
So we could expect more of the same, another record quarterly profit, perhaps?
Well, we had a couple of one-timers in the first quarter numbers, which are not likely to be repeated every quarter. There won't be one-timers. One, we had a very strong trading quarter, and that was after a very weak trading quarter in the fourth quarter of last year. But, give or take, in a regular quarter, we expect to make about $200 million. The first quarter was 300, and so that's unlikely to repeat. Also, because of the improvement in the economic conditions, we, from an accounting standpoint, had to reverse some general provisions we had, and that's also not something that will happen on an ongoing basis. But even ex that, I think business should be relatively okay. Our first quarter, we had a 14% return on equity, and it's hard to see us maintaining a 14% return on equity. But we've given guidance before that approaching 13% is doable.
Let's talk about the disruption risk, because that is affecting a lot of banks. The MAS has asked for some retraining as well, particularly in the face of branch closures and job cuts. How are you working to retrain staff in this new fintech environment? And I guess, are you concerned as well with the ageing of the population of local employees, as whether or not we can see some retraining?
Well, let me take the back end of that question first. I'm a big believer that everybody can be reskilled and retrained. I've said before that every one of us in our personal lives is changing. You might be 50 or 60 or 70 and you know how to use FaceTime, and you can Skype, and you can order Uber or a Grab. So if you can make that change in your personal life, there's no reason to believe that you can't be skilled and trained in your professional life. And frankly, in DBS, we found that to be true over the last few years. We are taking all our older folks, and they're at the vanguard of all of the transformation that we are doing. On the job displacement, it's a real issue, but we started worrying about this in 2016 when we first figured out that we'd probably be dislocating almost 1,500 jobs in Singapore in our branch system, in our call centers, and so on. And we put in place a really strong development program for these individuals so we could find them alternative opportunities within the bank with an appropriate amount of training. So to date, we've actually trained 1,200 people. We've actually moved about 900 people to new roles. And in the meantime, we've been shrinking our staff requirements in areas like the branch banking system. And we've been relatively successful at doing this. So again, we're pretty sure it can be done because we've been able to do it so far. The problem is, of course, as it keeps going, and if you project out into the future, if more and more jobs go, then it's not clear how many alternative jobs you can keep creating. Yeah. But for the time being, it's something that we've been able to get our hands around.
And in terms of looking forward, in 5 to 10 years, how much of DBS's workforce do you think could be replaced by tech?
That's a very hard question to answer. I mean, people have come up with estimates from 30, 40, 50, 60%. I think everybody comes up with a number like that. But I think it's fair to say that a large number of jobs can be displaced. Robotic process automation takes a lot of the regular routine jobs out, and more AI can actually replace a lot of human thinking. So there's no question that the logic would suggest a lot of jobs can be impacted. What we're finding, though, at the same time is that new jobs are also being created. If you look at our own situation, I already said we've been shrinking jobs in some areas, but we've been growing our headcount. And so we've been adding people in data analytics, we've been adding people in tech in general, design, but we've also been adding people from a humanities kind of standpoint. People with some ethnographic kind of thinking, anthropologists, human behavior, human psychology. So we've been able to come up with creative jobs, design people. So for the time being, we continue to add people. Now, do we get to a stage where the net rate of reduction increases the rate of intake? I don't know.
Yeah. In terms of fintech as well, providing opportunity, I guess, for customers, where are you in that space in trying to, I guess, stay ahead of the curve in this push for fintech?
Well, we started our transformation journey several years ago. In fact, in some ways, I say we started 10 years ago because we made a down payment in terms of our infrastructure, our back-end systems. But in the last 5 or 6 years, we've been really focused on reimagining the nature of banking, how we acquire customers, how we interact with customers, how we use data, and so on. And as we've again demonstrated on a couple of occasions, we are seeing payoffs. We are beginning to find that the digitally engaged customers give us a return on equity of 10, 12 percentage points higher than the non-digitally engaged customers. So we're rapidly migrating customers. We're also seeing an increase in our product profile. So we can do products and services today that we couldn't do 3-4 years ago. So costs are coming down, revenues are going up, we're getting a lot more market share. So I think we're on the right track.
You've also sort of been pushing into fintech in terms of some M&A. I think of Carousel, also you've got a small stake in Casisto. What kind of further acquisitions are you looking for? Do you have an M&A budget?
Actually, I wouldn't call it M&A. We'd make take small stakes in companies where we think having a seat at the table will allow us to use the resources or the capabilities of that company as part of our strategic agenda. So unlike a lot of other companies, we don't have a venture capital agenda. We don't just invest money for the sake of investing. We look at opportunities where a startup might bring value to our strategic endeavors. And if we think that that works, then we'd be happy to put some money in. We haven't done a lot. We've done only 3 or 4 of such investments. And this will continue to be opportunistic. If we find the right opportunity from that prism, then we'd be happy to entertain it.
We've seen Hong Kong regulators opening the door to virtual banks. Do you see that coming to Singapore?
I mean, I see no reason why it would not. But think about opening the door to virtual banks. It sounds like a fantastic thing. To my mind, they've just basically given a few more banking licenses. It's just that these banks will use a slightly different banking model. And if you've already been transforming yourself, the model that they use is not very different from the models that traditional banks use, assuming you've been changing yourself. So I think the right prism to think about is that, will there be more banking licenses? That's all that question really means to my mind. The real challenge is if the regulators create an unlevel playing field and they let the new bank licensees come in and do banking on different terms, lower capital, no same rules, less liquidity, etc., then that could be problematic. So far, most of the regulators don't seem to be inclined to creating an unlevel playing field.
I just wanted to finally ask you about Highflux. Now, no impropriety found from the MAS in terms of DBS here, but there was a large number of scale of losses for retail customers. Are you changing the way in terms of, I guess, some of the investment products that would be sold or could be sold to retail investors?
Not really, because finally, the investment products to be sold to retail investors is not our jurisdiction. It is the regulator. And this is true not just in Singapore, in every country. It is for the regulator to say if they think some product is too risky, then they say don't sell it to retail, otherwise sell it to retail. You take equity. And the most risky product technically on the asset stack is equity. Certainly it's not for us to say whether a company should be able to get a public listing or not. There is a regulator and an exchange whose job it is to say whether the company should be able to list and float equity to the public. From our standpoint, we continue to make sure that we do all the due diligence that is appropriate and required, whether it's legal due diligence, accounting due diligence, and so on. You take something like Highflux. We make it available on ATMs as a payment channel. And that's like a lot of products we make available at our branches. That does not necessarily mean that we're endorsing or pushing or asking people to go buy the product. That's something for the regulator to determine.